workers losing their jobs as a direct consequence of AI overtaking jobs. I think we're pretty far from that at this point. I personally don't know a single software engineer who has lost their job to AI, been replaced by AI quite yet. Not saying it won't happen in the future, but what I do think is going on, and the reason it is directly related to AI, is that companies like Microsoft, obviously, we will see others as well, are sort of restructuring, reprioritizing, reorganizing, which, is a nice way to say laying people off ultimately, in order to meet the demands of this new era of this technological transformation. So it is related, it is indirectly a cause of AI, but I don't think we're seeing people losing jobs because AI agents are taking them over.
I was born and raised for a time in Juarez, Mexico, while my mom traveled to the U.S. I reunited with her when I was 7.5, 8 years old. My ambition is to show gratitude, I guess. It's what's led a lot of my leadership ability, is to always be grateful, always be mindful, always be inclusive of people's views. When I arrived to United, it was clearly a turnaround situation. It is uncanny how much of your answers to all your questions lie resonant in the people that work for you. Listen, learn, and only then should you lead.
Live from the New York Stock Exchange, Halftime Report, CNBC.
All right, I'm tight in sales yesterday would have been. Yeah, man. I'm shocked. Because yesterday was a clear opportunity. It really was.
We are just a few seconds away from August PCE inflation data. Ahead of that, the futures are in the positive territory at this point. Dow futures up by 150, S&P futures up by 11, the NASDAQ up by 16. Rick Santelli is standing by at the CME in Chicago. And Rick, take it away. Oh, wait, it's 29, not 30. We got an entire minute left to go, so let's talk a little bit about this. We are
guys, looking at this print so far, as expected, as we can see that the yearly came out at a 2.9, so this really doesn't give us an edge. All right, so that's the worst.
Yeah, we settled last Friday at 413 and a 10. We're up a couple of basis points.
I don't like this print. I don't
it's
think
interesting on a two-year note
really
that they settled last Friday at 357. So they're up about 7 basis points. They're up more, and I think that's very telling because the short maturities yields have increased a little faster, flattening the yield curve. And why is that so important? Because it goes right to the heart of what market's paying attention to. Any strength at all in the economy, particularly in the labor market, will result in more upside in yield, downside in price to the short end because of its association with the Fed, even how the Fed has underscored labor. And here we go. The income, spending, and PCE numbers should be hitting the wires here. These are August numbers, some of the Fed's favorite inflation gauges. And of course, I'll have to tap dance a bit as I don't see some of these numbers. But just as a preview, we're expecting up 3/10 on headline. And here it comes. Comes in a smidge hotter, up 4/10 instead of up 3/10. Exactly the same, at least up to this point, until I see revisions equals last month. So 4/10 back to back. How does that comp? You have to go all the way to April of this year, mid-year basically, and find a higher number, up 8/10. Also, on the personal spending side, the income is a little warmer. Not bad. Spending, well, it's a little warmer too, by 1/10, up 0.6%, a little better than 0.5%, which is what we were expecting and what was in the rearview mirror. And up 0.6 will be the best spending level since March when it was up 0.7. Now, if we account for inflation, make an adjustment. Let's call this real spending. It's up 0.3%, still better than expected, equals the rearview mirror. To find a better real spending number, you're going to March once again when it was up 7/10. Now let's get to the meat on the bone. The PCE numbers on the month-over-month up 0.3 as expected. That is 1/10 hotter than the rearview mirror. 0.3, well, that would be the warmest since February when it was up 0.4. In Jan and Feb were the highest readings of the year. Both up 4/10. Now, if we look at the year-over-year, it's 2.7 as expected. Once again, 1/10 hotter than the 2.6 in the rearview mirror. 2.7 equals where we were in February, which was the high of the year. To find a higher number, you're going to March of 24 when it was 2.8%. Now I think the most important numbers, we look at core PCE, month over month, up 0.2. Good news, not only is that as expected, it's 1/10 cooler than the rearview mirror, which was up 0.3. And finally, the most important number of all, in my opinion, core PCE year over year up 2.9%. Same as we're expecting, same as last month. And the high reading of the year was February when it was 2.95%. If I had to look at this and summarize, here's what I would say. Is that if you're looking at inflation and trying to dismiss it, I think you have a hard time doing that. It isn't necessarily getting much warmer. The thermometer, vacillates a tenth here and there. But the issue is stickiness. So how does that fit in the Fed's profile on their easing campaign? Listen, I can't speak for them, but it is sticky. And one of the denominators of this has been sticky a while. So any who are looking into the political spectrum on some of the legislation or potential legislation, I think they'll have a tough time. But it just seems to be stuck a bit. Yields really haven't moved all that much. We're now at 4.16 in a 10-year. And 4.16 would be roughly unchanged on the day, up 3 on the week, as we pointed out. The pre-opening equities seem to like it as they've enhanced some of their green just a smidge. Becky, back to you.
Hey Rick, people who say the Fed didn't move the goalpost to 3%,
all right, I'll fix it after.
Say that the Fed still thinks that we're headed in the right direction and they can wait this out and that it's not going to.
How about now? It's clear? Javier, all right, good for you, Javier? All right, cool. All right, got you. Yeah, I forgot about the news. All right, so as of right now for this session, I wouldn't take, equities is pushing higher because at least inflation is not lower than expected, and it's going to be continuations from yesterday because yesterday we did have strong growth data, right? So that also supports the stock market. And we still don't have anything else that will trigger sells for NASDAQ or US 30. We don't really have anything that could trigger those sells to come in place. Yeah, so this is why I could see that NASDAQ and US 30 is pushing higher for the session. It makes a lot of sense. But when it comes to the dollar, right, we don't really have an edge for the moment. But just because of what happened this week, right, especially from Fed speakers talking, we see that they're going to play that hawkish pause approach, which is supported for the dollar, but strong growth. Even if the Feds are still looking to cut rates but be slower, a slow pace, the fact that growth is still strong still supports upside for the stock market, okay? Does that make sense, guys? Just put a 1 if it makes sense. So even though, right, the Feds is not going to hike rates. So it's no real reason. We don't have a clear catalyst today for us to want to sell off the stock market, right? If the opportunity does come, we're going to find it. We're going to see it. But I would say, right now, the only reason I could say that, all right, we could see NASDAQ and Dow Jones pushing higher is because at least we didn't get higher inflation, but we also had a very good growth print yesterday that's still showing that that obviously growth data is still good for the U.S., which supports the stock market. But when it comes to moving forward, right, we need to have an edge. So even though that inflation today didn't really give us an edge, we could still I think we got a Fed speaker coming out probably in the next hour. We could see what that Fed speaker says, but I don't think it's going to matter as much. Most likely, if I could still see equities continue in this direction, but if we can see that Michigan sentiment data is lower than expected, I would say that we could take advantage of that weaker dollar. Gold is just going to do the opposite of the dollar and the yields today. All right. Bark speak at 20 minutes. Yeah. We can see what he says, what Birkin says, but I don't think it's going to be market moving as much. If this was a higher print, yeah, like Bowman maybe. If this was like a lower print, then a Fed speaker confirming, more rate cuts, that would matter. Like if this was a higher print, then in 20 minutes the Fed speaker confirmed that, we should be more cautious, then it would matter. I think like they're going to play that data dependent approach. So that's why I don't think it's really going to matter right now. That's just my opinion, like it's good to let's see what happens, but I feel like we just going to be, it's just going to be more like today is just going to be more focused on technicals. But yeah, all right, guys. So we could come back at around. We could at 10. Yeah, we could come back at 10. All right, just equities already took. Anybody took buys on equities. I didn't take it. You had another bag for USD. Yeah, good job, bro. You took the break of structure, right, Reese? Yep. Yeah, exactly. Good job with that. German. You took German 30. Yeah, I'll be a little cautious about what's going on with tariffs in Europe. But, yeah, good job, Rob. I like the buys in that, too. Yeah, it was really clean. Yeah, I like German 30 structure, too. It's moving real clean today. Yeah, you took buys from. Yeah, I think the gold buys is good. Like buying from support, Farco, I think it was really good. I mean, gold could continue. Most likely, if the dollar and the yields push lower. I think if we get at 10, if Michigan sentiment, if inflation does come out lower than expected, I think that would be an idea for a weaker dollar that we should probably see gold push up higher. But as of right now, just on the screen, you're just waiting for a break of structure. Right? Right now, this support, I probably wouldn't. I would wait. I would have an alert set at 37.27 and then another alert at 37.60 and just focus on market structure moving forward. Because as of right now, we don't have a clear reason for the markets to give us an edge because this inflation data didn't really give us much, which does suck. Yeah, I felt like they're manipulating the numbers. Crazy. Yeah, usually if there's a risk on market, that's what's going to push the entire stock market, even global markets is going to push higher today. All right, guys. Yeah, have a good one, Reese. Have a good one, man. All right, guys. That's really it.